Hi, my name is Darren Joseph from HTJ.tax, and we're the team that seeks to demystify that sometimes confusing world of international tax. And today we have the honor and privilege of having another conversation with Leonardo. Leonardo, could you please introduce yourself?
Yes, Darren, thank you very much for having me. I'd like to start by saying hello to everyone that is watching. My name is Leonardo Marques Sanchez. Just call me Leo, it's easier. I'm a tax lawyer, a tax partner in a law firm in Portugal, also a tax law professor at the Portuguese Catholic University. My main areas of focus at this point are national, domestic and international issues pertaining to individuals. So I think that's a little bit of what we are going to discuss today, right?
All right, fantastic. And I guess following on from the last question, is there a risk of double taxation? Because I'm declaring my worldwide income. I'm in Portugal, a Portuguese tax resident. I'm declaring my worldwide income. Is there a risk of double taxation? And if so, how is it mitigated?
Yes, there is. Obviously, if you're deriving income outside of Portugal, or if for some reason you're deemed resident, even if for a portion of the year outside of Portugal, absolutely, there is a risk of double taxation. So this is one of the points that is crucial when you're planning to move, I guess, for Portugal, but for whatever country, we need to make sure we avoid double taxation. So in the case of Portugal, we have close to 80 tax treaties in force. And in cases where we don't have tax treaties, we also have unilateral tax credits. So chances are we are able to avoid double taxation. Again, the case of the US nationals may be slightly different because correct me if I'm wrong, you're taxed on a worldwide basis based on your nationality. And you would be taxed in Portugal on a worldwide basis based on your residence. So basically what we need to make sure is that by creating a new worldwide criterion, residence in Portugal, you don't increase your tax burden in the US. So US nationals always require a little bit more analysis, but in respect of double taxation, chances are we are able to reduce or completely eliminate double taxation, but we need to pay attention to that. We need to have tax residency certificates. Why? If tax residency certificates take a long time to get, well, let's make this planning ahead. Let's make sure you cut your ties in your country of departure so as to avoid residence conflicts. So there are things that we must do to plan the relocation so as to avoid this nuisance of double taxation.
Well, let's take a deeper dive into that. So let's take the example, as you mentioned, of a U.S. exposed person. So a U.S. taxpayer moves to Portugal, becomes tax resident in Portugal, and they have securities income arising from the U.S., which, assuming it's long-term, let's say it's long-term capital gains, that's 20% plus 3.8 net investment tax, so 23.8. Now, Portugal, generally speaking, taxes foreign securities income at 28%. Which of course creates a higher tax burden than had they not become Portugal tax resident. I see a lot of discussion and perhaps some misunderstanding in a situation like that about the applicability of the double tax treaty. Can the double tax treaty be used to mitigate that situation, reduce the overall tax burden?
I think the operative word here would be mitigate, because I think you'll be taxed at 28%, so you'll be able to credit that against your tax assessment based on residence. But now correct me if I'm wrong, I think you will not be able to carry forward the excess of foreign tax credit. So if you are given a credit of 28% over a effective tax rate of 23, did you said, or close to that?
Yeah.
I think your overall tax burden will increase. So yes, double taxation will be mitigated in a way because you're not going to pay 20 plus 28, but there will be an increase in the overall tax burden, I think.
Right. So Portugal would allow, because presumably the US will have primary taxing rights because the income in this scenario arises in the US, right? So Portugal will allow a credit for taxes already paid in the US. No, Portugal will want to tax it first.
Well, you're talking about securities.
You're correct.
Right? I think it will allow a credit, yes.
Yeah. Right. But
what we need to we need to see exactly how the income will qualify.
Okay.
The thing is, we have the allocation rules in the US Portugal tax
Mhm.
treaty, which are
Yeah.
similar to OECD model or other models. And so you need to see whether it is interest and there is a tax reduced withholding tax at source, or if it is sort of a different financial product. But there is a new element in the US treaty,
Okay.
which is different from most of our tax treaties, which is
Mhm.
US, according to the tax treaty, to the protocol to tax treaty, US nationals will be taxable based on nationality. And
Right.
so it's slightly different from what will happen in other treaties. Why is that? Because in other treaties, if there is a taxation on the income from securities, let's assume it's other income, it qualifies as other income, which is taxable
Okay.
only to residents, and
Mhm.
there is taxation at source. I don't think Portugal will have to grant a credit. Why? Because taxation will not follow the allocation rules of the tax treaty. Now, in the case of the US, because there's that slight difference on the taxability based on nationality, yes, I think there will be a credit.
Fantastic. Thanks a lot for that. Leo, if people wanted to get in touch with you, to hire yourself, to hire your team, what's the best way to find you?
I think I can be easily found on Google. So just Google my name,
Mhm.
Leonardo Marques dos Santos, and I think the law firm, Miranda's law firm website will immediately pop up with my email addresses. That will be easier. I'm easy to find.
All right. Fantastic. Thank you.